Hello there, folks, and welcome back once again to another episode of Southbank Live, episode 48, no less. Sadly, YouTube is playing up once again, so this one is only going to be on Facebook and LinkedIn. We shall be posting the links in the respective YouTube live stream. Apologies for that again. We have had quite a few issues with this over the months in recent days. I'm streaming this one actually from the Solana Hacker House here in Shoreditch at the minute. It's quite a strange location. They actually have a special dedicated podcast room. But yeah, that's me in this, what looks like a prison cell, John. I think you're in much more plush surroundings. How are you getting on this week?
Oh, I'm getting on very well. It's quite lovely here, I have to say.
Yeah, the weather is quite something. I think we're all in need of that, given the the prevailing market environment at the minute, which is
Indeed.
not exactly hospitable in a lot of ways, and that's what we'll be going to in this episode. Again, sadly, YouTube is not working at the moment. We're making do with Facebook and LinkedIn. Hope everyone can join it and they're not left in lurch. We'll be leaving a comment in the YouTube live stream. Now, yeah, just to start us off, John, in terms of your long and your short for the week, do you have a long and a short that you can share with us this episode?
Oh, absolutely. And it really it's something that's going to feature very, very solidly in our discussion today, because you see this whipsaw in markets now, right? Which is historically characteristic of turning points. Major turning points see elevated volatility, whipsaw, back and forth, back and forth. And we're seeing that with the dollar itself. Now, I've been calling for a dollar top for weeks now. And indeed, it looks like that top is forming. And today, you can really see the dollar coming off hard again. So this whipsaw reversal process, I think, is well underway. And I think the dollar is indeed in for a major correction lower versus other major currencies. As you say, right? I mean, things run quickly now, and there's an air and aura of crisis almost everywhere. And so I really think that it's time also for the precious metals to shine. And so I know I've called this my long and short, probably 3 out of the last 7, times we've had this discussion. But I really think it's the trade here. The chart, it's not just the fundamentals now, right? The charts are telling me the timing is almost precisely right to really get into it now.
Right. Speaking of the charts, there is a chart of the dollar index that I would like to share this evening. It's quite a dramatic chart, really. This one is so this is the DXY. This is comparing the value of the dollar relative to other major currencies. Not all major currencies, but not all currencies. That said, but just the major fiat currencies. And as you can see, we did get this massive spike in 2020. That's right in the middle of the chart. And then we saw this deep decline of the dollar relative to its peers until we get to about halfway through 2021, so pretty much a year ago, when we start to see this big acceleration. And if you look up at the top right, this was taken a couple of days ago, you can see that it's breaking even higher than it did in 2020 and more recently than that too. It's also led to a headline, which I thought was quite interesting, regarding the fate of the yen. And this is from the Financial Times. The yen hitting a 24-year low against the dollar, as Japan sticks to a loose monetary policy. Lots of things that we could discuss here, John. I think the fate of the yen is something that we've dabbled around in recent episodes, but it's such an enormous story. So the yen as a safe haven currency, this is a narrative that's persisted for a very long period of time. And yet the yen is really having a rough time against the dollar. Now, you think the dollar is going to go a fair bit lower. What do you make of the yen? Because 24-year low is remarkable. I mean, that's almost as old as I am. And it's pretty worrying to see that this is something that everyone in financial markets has taken for granted for a very long period of time, that the yen will be a safe haven currency. And just today, we've seen a really sharp move higher in yen government bonds, in the Japanese government debt. What do you think is going on here?
Well, look, Japan is in a very tough position. We discussed this recently. That is, not only are you seeing just general dollar strength, but we're really seeing also is, of course, this huge spike in energy prices. And unlike the United States, Japan is a huge energy importer. Now, they're also a huge exporter of various manufactured goods, as we know, but they do have to import. And so when you get a huge energy price spike like we're seeing now, that's really going to squeeze margins on Japanese firms. It's really going to hit their profitability. And of course, the Bank of Japan wants to try and buffer this because they do want to try and maintain easy money in this sort of environment. But when you combine, easy money to try to ease the economic pressure with the energy price spike, you do have a recipe for a weaker currency. Now, that said, I believe that's a temporary recipe for a weaker currency. And the reason I mention that is because Japan may be a huge energy importer, but they also have a huge net foreign asset position. And if you get into a proper general global financial crisis, that net foreign asset position, that is the net foreign balance sheet, it's kind of the national balance sheet vis-a-vis the rest of the world, becomes much more significant than just the day-to-day flows of energy or the day-to-day sales of exports to the rest of the world. What I'm talking about is repatriation of capital. If you get into a general global financial crisis, the Japanese are going to come under pressure to repatriate some of their capital invested abroad. And that, in my opinion, will shore up the yen and will turn it back into a safe haven. However, we're starting from this very weak position because this huge energy price spike has been occurring. But if that energy price spike leads to a general global economic crisis, I think the yen strengthens again. I think the dollar goes down because the US has a huge net foreign debt position, offsetting that large Japanese net foreign asset position. And the natural way for those imbalances to reduce, and imbalances always reduce in financial crises, is largely what crises are, getting rid of imbalances, then you'll see it reverse.
That's very interesting. The phenomenon of Japan having this massive net foreign asset position, and that's the Japanese, not just the Japanese investor, but also Japanese institutions having these huge holdings of financial assets, real estate, all manner of assets abroad, is something that's persisted for a long period of time, and it's been, the phrase is Mrs. Watanabe, right? The Japanese homemaker who is investing the family's savings is this force in the market, in global financial markets, which everyone has learned to sort of move around. But John, when you're thinking of that repatriation of capital, that means that Mrs. Watanabe, in this example, is selling these foreign assets. So what happens in global financial markets? What happens in real estate in the UK, where you have this big Japanese ownership? What happens to US stocks? All of these things that the Japanese have owned. How big are the ripple effects from this?
Well, that's the thing. Everything becomes vulnerable. So when you get into a rebalancing, that is when balance sheets matter rather than just day-to-day income or flows of goods and services around the world. That's when pretty much everything is in play. Because if you simply have to shore up your domestic position, so let's say that Mrs. Watanabe has a credit line that she has used to speculate on foreign real estate. Well, obviously now if the bank she's got that credit line from says, here's a margin call because we're concerned about general global financial conditions, with Mrs. Watanabe, she's going to have to liquidate some of that to meet the margin call. And so this is the problem. And we haven't got there yet, obviously, because the yen has been weak, again, because I believe because of the combination of easy money and the energy shock. But if you do get into a situation where U.S. investors have to call in assets to meet margin calls, that's largely a dollar story. Whereas in Japan, it's a very international story because huge net suppliers of capital to the rest of the world in various forms, as you say, stocks, real estate, you name it. And so when there is that general calling in, it doesn't help strengthen the dollar. Oh yeah, sure, of course, some stuff is repatriated to the U.S., but the net flow is out of the U.S. into Japan and other countries that have large net foreign asset positions. But where this really is a problem, because it's where foreign exchange movements help to resolve the imbalance issues, is within the Eurozone, where you can't do it that way. The currencies can't adjust. And that's where you get this potential fracturing, where you get a huge spike in target 2 balances. That is the internal imbalances within the Eurozone. And that's why the ECB had its emergency meeting today, because they realize now that these internal imbalances in the Eurozone are at the point where they really could start to blow things up. You could start to see a run on Italian banks, a run on Spanish banks, and this sort of thing. And they want to try and preempt it. They don't want to be on the back foot like they were when Greece blew up, a decade ago, right? They want to try to be ahead of it this time by already kind of saying, whatever it takes, using slightly new words that Mario Draghi used back then. So that's also something worth watching here.
Yeah, and there's lots of interesting themes around that we can explore, and we will explore. Hello to everybody who has joined us for this stream. Apologies once again for the YouTube issue, Roger and Robin. Yeah, it is it's an issue that we've had quite a few times. I hope we'll be able to fix it. We may just end up streaming solely on YouTube if that makes things slightly easier. But we'll make do while we can. Of course, we have booked the stream for this time, so we'll carry on with it. Do feel free to enter any questions or comments that you have in the chat. If you have a long and a short for this week, we'd very much like to hear it. John, just expanding on this. So let's start with Japan again. So we've got this big decline in the yen, 24-year lows. This is something that Japan's not been used to as well. How do you think the Japanese government might react to this?
Well, it's early days yet because we have not yet seen actual inflation realized in Japan. The CPI is still very low. Now, that's not going to remain the case. The energy price spike is way too large. The yen is way too weak. If you wait a few more months, you're going to see it trickle through into official Japanese CPI. And that will then get everyone's attention. So I think what they're doing is, because they've had this bias to allow CPI to move slightly positive anyway, they're kind of going to let it happen. They're going to do a similar thing, in my opinion, that most other central banks have already done, which is allow inflation to run hot to help erode some of the debt issues, right? The accumulated debt issues they've got. Allow inflation hot and be purposefully behind the curve. Go ahead and burn through a little credibility and be a bit behind the curve. Allow inflation to run hot. I think Japan's following a similar strategy, but they're following it from a very different starting point, where CPI has remained very, very low and stable so far. I don't think that will continue, and that will change the psychology in Japan. And then, of course, you will get in Japan. They will start to tighten monetary policy. And if they do so at a time when the global economic cycle is already rolled over, and it's looking like it has, just in the recent months here, then you're going to, in my opinion, you're going to have the yen be strengthened a lot in a short period of time. If the global situation begins to roll over, you get repatriation of capital, and the Bank of Japan begins to tighten policy.
This is a really interesting theme. You were already talking about the whipsawing of markets earlier, John.
Yes.
And there seems like there's a perfect situation for that with the yen. When you're thinking of how the yen's decline, and you get this repatriation of capital from the rest of the world, where in the Eurozone would you see that exhibit itself the most? Because it's not something I've thought about. Where's the biggest amount of Japanese held assets in the Eurozone? Is it things like German real estate?
They own stuff everywhere. They really, really do. Historically, they're huge investors in Germany because if you think about it, Japan historically, and this remains largely true today, is a big manufacturing powerhouse. And of course, Germany, historically, and also this largely remains the case today, not in quite the same degree, huge manufacturing powerhouse. So they kind of naturally think alike. And it's very common for Japanese firms to have their largest European subsidiaries for manufacturing and distributing whatever it is in Germany or nearby. That is sometimes in the Netherlands or Belgium, right around that part of Northern Europe. But that said, they own everywhere. They really so if they're repatriating from Germany, yes, of course, that could impact the euro. But the thing is, Germany itself doesn't have issues with the Eurozone with respect to its balance of payments. It's a huge net creditor to the rest of the Eurozone. Yeah. So to the extent you're getting a general repatriation of Japanese capital from the rest of the world, and to the extent a portion of that's coming from the Eurozone, then the part that really matters, that really could cause a problem, is the repatriation from the weaker, debtor countries in the Eurozone, such as I mentioned, the big ones being Italy and biggest ones being Italy and Spain.
Right. So it wouldn't be immediately apparent that this was caused by a Japanese repatriation of capital.
No,
right.
And it's just it's a big straw on the camel's back. I mean, there's lots of aspects here that could play out with respect to cash flows within the Eurozone. But other factors equal, as people within the Eurozone get nervous, they'll repatriate into Germany and the perceived stronger countries' banks. And that will increase these target 2 balances effectively held on the ECB's balance sheet. To the extent they let that run with a weak euro and with inflation running really high, inflation could keep getting even higher, and that becomes a huge political issue within the Eurozone. And at some point, the Germans might begin to push back, and then all hell breaks loose. Right. If Germans start to even indicate that they're not going to let the ECB continue following such an inflationary policy indefinitely, almost stating the fact, almost allowing the genie out of the bottle into political discourse, can cause the crisis itself.
It does feel like there's so much existing strain within the system in the Eurozone, given just even the past 2 years, that it won't take much before something cracks. But then, we've been saying this for a while, and they've managed to get away with it. So who knows? Maybe they'll be able to pull something out of the bag. But
the thing is that even though this has been going on for years, that is, various pockets within Germany, political sort of pockets, have tried to draw attention to this issue, that what the ECB has been doing, arguably for over a decade now, is simply goes against the Maastricht Treaty, is clearly in violation of the proportionality issue. That is, the ECB is supposed to acquire bonds to provide the monetary base in a proportional way, that is proportional of all the member countries' bonds that are being issued. But they clearly have disproportionately acquired Italian government bonds, Spanish government bonds, and so on, because that's the only way they've been able to prevent crises at various points in time. And the German Constitutional Court has heard more than one case brought to it regarding various aspects of this issue. And they did indeed say last time it came to the fore that they needed a fuller and clearer explanation of the ECB's actions are still in keeping with the finality clause in the Maastricht Treaty. And they kind of fudged it. Okay, they kind of fudged it. They didn't want to make it too black and white. They didn't want to force the ECB to suddenly unwind all these positions, because that would be so disruptive. But that was when inflation was still low. That was before this huge inflation spike. So now that you've had the inflation spike, and Germans aren't stupid, right? They recall this proportionality issue being debated, and they understand that one of the reasons why it is an issue is because it's potentially so inflationary. Well, now the inflation's here. You're going to get a political response at some point. It might take a few more months, but there's no way this is not going to rock the German political boat, and by extension, the whole Eurozone.
Big time. Yeah, expect chaos at some point to erupt. How do you think? What would you look for, John, when you're seeing sort of you're hearing the thunder, or you see the flash of lightning? What is it we should be looking for?
Well, we've already seen bond spreads blow out. That is, the spread of Italian and Spanish and other countries' bonds to German government bonds. That spread blowout has already been happening. And indeed, that's arguably why the ECB converged this emergency meeting to try and see if they can come up with some special facilities to try and contain that. But notice how black and white it is becoming. If the ECB is holding emergency meetings to do something which has already kind of been admitted is in violation of the Maastricht Treaty, well, they're so far out of their remit. They're so far beyond their mandate. They're so clearly operating illegally. It really strengthens the hand of those in Germany who believe that they should find a way to shut this down. So again, the genie really is out of the bottle now. It's clear for everyone to see what's going on. So what do you look out for? Basically, I think that you have to assume the ECB is going to try and do what it's said it's going to do, which is to prevent potentially destabilizing financial conditions in the Eurozone. But I'd watch the political landscape in Germany. That's what I would do. Look for some, some perhaps slightly younger, upstart politicians to start really pushing this agenda and watch it sort of start to bubble up to some extent within either the ruling coalition or the other parties. And if that begins to progress, then I think the sparks will eventually fly.
Do you think financial markets will get ahead of this before we see that, or will it require some really provocative statement from, say, a young nationalist upstart to cause that to occur?
It's hard for bond markets to front run anything that a central bank is absolutely committed to prevent, right? It's very expensive to do that. And so you might well need, the shock of a headline to kick things off. So, anyway, I just think that all the ingredients are there now for a crisis kind of like Greece, but on a much bigger scale now, because the size of it, the size of the internal imbalances in the euro area are so much larger than they were back then. And indeed, the whole world's imbalances are so much larger than they were back then as a result of this additional decade of monetary largesse that we've seen.
Certainly. Now, we have quite a few very interesting questions and comments on this topic in the chat. Good evening to everybody who has joined us. Apologies once again for the faulty YouTube stream. We get a question. This one's really quite in-depth from Alexander, who says, regarding Target 2, as the Italian and the Greek national banks are the debtors and the German banks are the creditors, why would there be a run on the Italian banks and not on the Germans, John?
Well, because the problem is this, right? The reason why the Italian banks are the debtors is because they are seeing their deposit base decline because people are taking deposits out of Italian banks and putting them in German banks. So what that actually means is that when you look at their capital ratios and whatnot, in this case, the Italian banks are significantly weaker. And the German banks have a much more solid depositor base. So the Italian banks are hugely reliant on ECB credit, direct credit with the central bank, because they're losing their normal commercial and retail depositor base in the private sector. And again, that's true of the other weaker Eurozone members as well.
Yeah, everywhere else that's called a bank run, Alexander.
Yes.
But
and the only reason, keep in mind, the only reason it hasn't already become a bank run, in fact, already back when Greece was in trouble, when you briefly had a bank run, the only reason why it hasn't already happened this is because the ECB has already been heavily intervening in the market to prevent it from happening.
Yeah, the Target 2 balances are really, well, that they're in many ways just a means of masking capital flight, or it's like preventing capital flight via central bank bailout, except it's not a bailout because it's a credit. So in theory, it's a loan anyway. But yeah, it's not a good time, I would say, to be an Italian banker. But who knows? Maybe they'll pull something out of the hat. Alice comments, this time the ECB are truly stuffed. How on earth are they going to pull this off? They're going to be hard pressed to PR their way out of this. I agree, Alice. I'm very interested in what the PR from the ECB, how that runs, what narrative they're going to take. Christine Lagarde is, she's very good at making on a good presentation. So maybe she'll be able to say something. But I think, to be honest, John, maybe I'd love your input on this. Feels like they're going to need Mario Draghi to say something in order to make this a bit better, even though Mario Draghi is no longer in the central banking business. It feels like all of the bureaucrats, the Eurocrats, the technocrats will be relying on him to, say something. Come on, Mario, get some of that past glory back. Say something that'll make it all work. What do you think, John? Do you think it becomes a political means of solving financial problems?
Well, clearly that's what they're trying to do here, right? I mean, they are absolutely positively trying to take the political initiative to work completely outside of the ECB charter within the Maastricht Treaty. They're trying to acquire new powers, and they're trying to claim, political necessity and expediency for those new powers. And of course, as is typical in these sorts of things, if you get the powers temporarily, they end up becoming permanent. And so when Draghi made his famous "whatever it take" comments many years ago, I mean, Lagarde has already paraphrased that effectively. So we're kind of doing the same sort of thing. The ECB is actually explicitly trying to assume powers that it really doesn't have. And again, that's where ultimately the only way this is going to be resolved one way or the other is the politics. They can, I mean, look, if no one stands up to them, if Germany does not stand up to them, which I think is unlikely, but if Germany never stands up to them, they can inflate as far as they need to inflate to completely recapitalize the Italian and Spanish banking systems. I mean, what would that take? It might take 10% inflation for a decade. Is Germany really going to put up with that? I don't think they will. But the ECB is trying to acquire the power to do precisely that, in my opinion.
Yeah, it's maybe whatever it takes is no longer good enough. We're going to need something even better than whatever it takes. Maybe an appeal to divine authority or something. But I'm sure it'll be all over the headlines. I'm sure the press will be definitely trying to help whatever the politicians and central bankers are trying to do. As I said earlier, a lot of interesting comments on this one. Seamus asks, would a Japanese repatriation favor the Japanese stock market, or is it cash only, such that we should invest in Japanese mattress manufacturers? What do you think, John?
It would do both. It would both strengthen the yen, which of course would strengthen cash in the mattress, as it were.
Yeah.
But it would also lead to a relative outperformance of the Japanese stock market, in my opinion. There's a couple reasons for that. First of all, net, if the foreign investment flows reverse and return to Japan, then to the stocks, you're going to hold your domestic market. And so that should lead to a relative outperformance. Obviously, in currency adjusted terms, currency strengthening as well, then you can get a kicker there. You're winning on both. But the other reason is that if you take a look at valuations, the Japanese stock market is simply cheaper in valuation terms versus the US by a substantial margin. Now, that doesn't mean that all of Japan all of the Nikkei, et cetera, is trading at deep value. But a lot of it is, not far from historical averages. And in some cases, it is below. Whereas in the US, as we know, and as I've ranted on time and again, valuations for most sectors, not all, most sectors are well above historical averages. So I think it's kind of win-win-win for the Japanese stock market in relative terms if you do get this repatriation or rebalancing, which is characteristic of financial crises.
An anonymous LinkedIn user says it would be interesting to see how far Germany's credit line extends in Target 2, as last month's credit Germany balances are near enough cancelled out by Italy and Spain's other side of the debt. Is the rest of the EU living off Germany's free will? Is the rest of the EU living off Germany's free will, and will they back them to the hilt? Well, that's certainly what Southern Europe wants Germany to do. But as John was explaining, does Germany really want to do this? Are you sure about that? Says perhaps disaffected millennials in Germany. What do you think, John? Like in the end, push really comes to shove here. And you had to take one side or the other.
Look, I've lived in Germany. I've worked in Germany. I have lots of German friends. And one thing that I do. And one thing that you learn living and working in Germany is you learn just how to perceive their own history. And obviously, they're horrified at what their country did in the first half of the 20th century. And yet they're told and taught, very, very clearly that one of the most important reasons that Germany got into the situation it did and embraced extremism and did, all kinds of horrible stuff for a time was because of the great hyperinflation, which impoverished the middle class and which totally destroyed the centrist ruling coalition or coalitions of the Weimar Republic, making it impossible to govern the country in a peaceful way. And it led to street fighting between communists and what would become the Nazi Party. This went on for years.
Yeah.
And Germans are taught very clearly in school that had Germany not hyperinflated the currency, it's highly likely that someone like Hitler would never have come to power. So when you're conditioned from a young age to understand that your country did some really awful stuff that you never want to repeat, and you're told that one reason for it was this hyperinflation, are you really going to allow the rest of Europe to drag you down that road against your will? I don't think so. At some point, Germans are going to dig their heels in and say enough.
Yeah, I think I think I'd agree with you there, John. For as much as so much has been done in order to keep the euro together, I wonder if this final and tallest hurdle is going to be doable. And of course, I'm not taking a side with what should or shouldn't occur with it, but yeah, this is such an enormous issue. I often feel that Europe is a continent that is trapped by its history, one way or another, and so many of the same modes of thinking are repeated. In France, and then in Germany, and then of course you have go to the east, you have the Russian angle on it too. And while everyone hopes that the European project can, transcend all of this, I wonder whether or not it's just another structure which is as fallible as the men who created it, and won't end well. Plenty other comments here, which I think is pretty interesting. Robert says, "Is the euro is crashing out of the euro really possible? Will they simply build their way out of it in some way?" Well, that's obviously what all the folks in the European Central Bank think can be done, provided that everyone believes that they're the masters of the universe. But what does happen is maybe something else. And that, of course, as an investor, you need to be pretty prepared for that, because crashing out of the euro. Where would we begin, John? What happens if Germany says enough?
Oh, I mean, look, all hell breaks loose. What I think would happen, though, is what would happen. I mean, don't get me wrong. I mean, look, Europe has been through currency crises before. This would be particularly difficult to get out of, because you have to redenominate all the contracts, and that's legally a bit messy. But there are ways it could be done. So, for example, let's say that Germany finally tells the ECB, you can't do this anymore. You have to go back to proportionality in your bond purchases, and that leads to basically the ECB not being able to continue band-aiding, these target 2 imbalances. So you get a proper run on the Italian and Spanish banks. Beyond a certain point, the Italian and Spanish governments are going to step in, and they're just going to say enough. They're going to freeze bank accounts. They're going to get the legals done, probably over a weekend. And then they're going to come out on Monday morning, and they're going to say, okay, you no longer have euros in your bank account. You have the new lira. And the exchange rate is this, which just happens to have lost 30% of its value versus the euro that you had last week. And of course, Italians will be furious, but that is the way they will do it. Something along those lines. It'll be a big one-off devaluation. If they're smart, they'll devalue this new lira, which again, they just basically all euro contracts immediately become, with an Italian counterparty, immediately become new lira contracts. They'll devalue that new lira to a level which is credible, because otherwise you won't relieve the pressure. And it's really, really stupid to go through something that big, that difficult, that disruptive, and not get it right. So it'll be a big one-off devaluation, in my opinion, assuming they choose that course of action.
And even if they didn't deliberately devalue it a lot at the beginning, I mean, the market would do it shortly after, surely, John.
Well, that's the problem. And see, they have no ammunition, right? They don't have enough reserves. If you can't rely on the ECB and you've got to rely on your own national reserves, that's not a whole hell of a lot of ammunition. And so I think, to play it safe, and I mean, again, if I were advising them, obviously I'm not, I would say devalue by a lot. If anything, slightly overshoot and invite the market to actually prop up your new lira a little bit, because and then you found a new equilibrium. Now that's the short-term fix. The long-term fix is different, right? If you're a chronic net importer, if you if you don't have a reasonably competitive economy, if you have a bloated, inefficient welfare state, your country's going to continue to underperform, and your currency will continue to underperform longer term. But those are longer term issues. The short term fix is just a big one-off redenomination and devaluation. I suspect that's how it will be done.
Yeah, but then one dreads to think what the political repercussions of that are going to be, and how that might manifest itself. Because, of course,
the nice thing about doing it that way, and this is similar, by the way, I'm not the only one to suggest that you do it this way. There are some very prominent European academics who have made a case along these lines. They're outside the mainstream, but there's some very smart people, including in Germany, who are associated with the premier German economic institutes, who have kind of said, we probably should consider something along these lines so we can at least get ahead of it and not have the whole thing blow up in our faces. So I'm not the only one thinking this way. So anyway, look, it could be done. It would be disruptive. But the nice thing, if it is done that way, Germany remains an anchor. You don't completely blow up the whole Eurozone. This northern bloc can still hold on to the euro. And they can provide this core of stability within the EU, to which a devalued, Spanish peseta or new peseta, whatever it is, and new lira from Italy, those devalued currencies will turn Spain and Italy into more competitive economies, at least in the short term, and they'll be able to export their way out to this northern bloc.
Yeah.
And they'll be able to rebuild. That, in my opinion, given how screwed up this is now, that's probably the best way forward.
Yeah. It's just going to be, if it does happen, it is going to be so messy, and it's going to take so long for stability to return.
That's the neatest, cleanest, tidiest way to do it at this point.
Yeah,
right?
and that's
you just wave the wand, you just wave the magic wand, as it were, over all existing contracts, and just say, hey, wherever it says euro, it's actually the new lira now, and this is the new exchange rate. Done.
Yeah,
right?
rip the band-aid off. And
I mean, there'll be all kinds of legal things, right? There's all kinds of lawsuits, and you know what? They're just going to have to throw the book out and say, sorry, we're starting over. Done.
Yeah.
Over. Yeah.
Well, it looks like somebody's just turned off the light in this room. So
there you go. The lights are gone out.
Yeah. Seamus asked earlier, what's with the austere room? Are you in custody for something? Well, I'm at a crypto conference at the minute, so you could say that, I suppose. This is the Solana Hacker House here in Shoreditch. I've got my Orca cap over here. I've even got a marinade chef's hat, which people are pretty creative with the merch over here in crypto land. It's quite crypto conferences are always quite wild and wacky, but it is quite interesting indeed. And we do get there's a question actually about crypto later on. But before we get there, I do have a few other questions. Roger, interestingly, has been making a bit of money, maybe even unintentionally, off the super spike in the dollar recently. We're just by depositing pounds and it automatically being transferred into USD. He has managed to make 100 quid, even though he wasn't really intending to do it. Good one, Robert. Hope that all works out. And David asked, is there a futures market for national interest rates? There certainly is, David, both long and short. It's a very big market as well. You want to trade Buchsel and Bund and Boppel and Schatz in Germany, you can if you want. Same over here with gilts, short-term, long-term. And indeed, you can even trade Fed funds futures if you want to go really, really close to the very tiny part of the curve at the very short end. I think that's a 14-day gilt repo. Maybe I'm incorrect there, but it's a very illiquid market, so it doesn't get a huge amount of interest. But it is indeed possible. When we're looking at, Roger says Greece was bad. Greece was bad enough. It was, Roger. Hopefully things don't go too awry. Now. This is from another John who says, John, you and many others have said recently to only stick with stocks that have tangible value and avoid intangibles. Isn't crypto the ultimate intangible? What would you say, John?
Well, look, I'm a well-known crypto skeptic. And while I do admire in principle the attempts that are being made to create coins that offer alternatives to what is clearly a mismanaged national fiat currency in just about every country in the world, no, I admire that. I mean, I've been encouraging people to think about how to go about that. And I've been, you say, Boaz, you're at a crypto conference. I've been to numerous crypto conferences through the years, but I am a crypto skeptic in that it's still very much an unproven technology when it comes to the store of value aspects of money. And you have yet to really, really uncover lots of end use cases where people are using crypto in a way that allows them to, basically do their day-to-day commerce and run their personal financial affairs in crypto. And so I am a crypto skeptic. And so I'm not surprised that when you get into an environment like the current one now, where there's just general uncertainty, general volatility, no one's quite sure what's going on, given that crypto is still unproven, I think there's just no way it's going to function like a safe haven. It just hasn't established itself enough yet. And this is even true of Bitcoin, of course. And so I'm not surprised you're seeing what you're seeing. So I think crypto survives this as a general concept. I mean, why shouldn't we stop looking for solutions to mismanaged national fiat currencies? Why shouldn't we look for alternatives? But as you know, there's one alternative that I've been advocating for the bulk of my professional career, which is tangible, which is physical allocated gold, which may be something that cannot itself be transmitted over the internet, but title to it can be transmitted over the internet and is regularly done so in huge volumes between huge numbers of players who actually have end use cases for gold as a long-term store of value or as something else, and such as jewelry. And so anyway, I mean that to me is where you want to be if you're looking for a safe haven, because it's so well established, right? So you
Yeah.
have the history there. No one has to sort of scratch their head and think, is gold going to hold up in a crisis? Gold always comes out of a crisis well. Look at 2008. Gold sold off with everything else only to recover first, and very, very strongly. So gold established its safe haven properties in 2008 for the upteenth time. And I believe we are going to see that again if things continue to develop as I believe they will.
Yeah, I think there's so many different angles of this we can explore. I find while Bitcoin has so much about gold embedded into it regarding its scarcity and regarding Satoshi's beliefs on gold, I think ultimately it's still traded like a tech stock on steroids for most of its life. And when it wasn't, that was when it was really, really tiny anyway. I think what will happen is that we see inflation break this relationship between tech stocks and Bitcoin will start operating as something that is more of a hard asset. And while tech stocks in general will suffer, but that's just my theory on it. I'm interested in how that will affect the rest of the crypto ecosystem when you're looking at Ethereum and Solana, as we are here today. I find it very hard personally to be long-term bearish on certain ecosystems like the Solana ecosystem where I'm in now, where I'm at this conference and there's an enormous amount of people here, some of them very young, and there's a huge amount of talent. It's remarkable how often you will meet somebody who is incredibly smart. And I've gotten the feeling, this is just my impression, that a lot of the clever people in a lot of other industries have left to then develop in crypto, which would explain their absence in sectors such as politics, finance, media, and such. But that is just my perception. And it'll be very interesting to see what happens. Liz says that How the Euro Dies by our colleague Nick Hubble is an excellent read. We would definitely agree, Liz, though, of course, we are very much biased. Seamus says, in theory, if they crash the euro so far as to make people's incomes comparable to the third world countries, then their goods and services will become competitive again. Indeed, I mean, that's ultimately what currencies used to do when the economies really do collapse and there's a lot of problems, is they reinflate it with a devaluation, exports become competitive, and as the anonymous LinkedIn user suggests, everyone starts taking holidays in Italy again. Well, I guess there is always going to be something of a bright side there. Roger asked, is the death of the euro inevitable? That's a nice, bold question, John. Do you think it is eventually inevitable? All fiat currencies, of course, return to their intrinsic value.
I think it's possible, as I suggested earlier, that you do get multiple countries leaving separately or together, recreating national currencies, devaluing those and then trying to restart their economies in that way and rebuild. But I believe strongly, in fact, there's going to be this core centered around Germany, which will continue to use a single currency. That core, in my opinion, will obviously include Germany itself. I believe it will include the Netherlands. I believe it will include Belgium. I believe it will include Denmark. And I believe it's possible that it also includes Finland and Austria. Okay. France is a question mark. And I used to think that France kind of got its economic act together well enough in the 90s, in the run up to the euro, that they'd be able to kind of hold it together going forward from there. But sadly, they really haven't. The French economy has underperformed the German economy fairly significantly now, on average, ever since the euro kicked off. So you're talking about 2 decades of France still not performing as well as Germany. And so I really question now whether France will remain part of that core that can continue with a single currency. Which may or may not retain the name the euro, but I do not believe that Belgium, the Netherlands, Denmark, and so on would have to leave. And I think they like having this. I think they like being in this currency union with Germany very, very much. But they're too small and don't have the political influence that France does. So Germany doesn't see them as a threat being involved in the conduct of monetary policy for that core, whereas France could be seen as a threat. And it's quite possible, in my opinion, that as a result, France will not continue as part of that core. And someday they will also have to recreate their own national currency.
I think the French would kind of like that, but that's just my just my impression. John S asks has a very interesting comment here regarding gold mining and gold miners. We have discussed gold in great length, of course, but you really, at times like this, it's time to be having conversations about gold nonetheless. Good evening, Boaz and John. Good evening, John. As a gold miner bug, I'm short gold miners when the gold price is falling and the crude oil price is rising, and long gold miners when the gold price is rising and the oil price is falling. Thanks are due to your colleague Shay Russell for reminding me of the importance of energy in miners' costs and demonstrating the inverse correlation between the gold miners index and the oil price. Good comment there, John S. What's your take on that, John? Because that would explain a fair bit of.
Look, I mean, fundamentally, that's absolutely right. Okay, gold mining is effectively a margin business. You put energy and time into digging this hole in the ground and getting stuff out, and then of course you sell what you pull out of the ground for the prevailing market price. So it's a margin business between your cost and time, of course, because time itself is a cost, and the market price you get. And so if that margin increases, miners become more profitable. If the margin decreases, miners become less profitable. However, while in theory that should work, keep in mind, there are lots of smart people out there who are trying to stay one step ahead of that, and who already may incorporate a view on energy prices into their valuations of miners, may incorporate a view on a range of factors into their valuations of miners. And so, again, not that I'm a 100% believer in the efficient market hypothesis, but you could say, hey, when it comes to oil prices or expectations thereof, it's all in the price, right? It's all in the price of gold miners already. So I wouldn't go quite that far. But yes, I fully agree that in principle, the fundamentals are as described, for sure.
Yeah, it is. It's always good to keep an eye on what oil is doing when you're thinking of investing in anything that requires a fair bit of energy. Now, there is another chart actually I'd like to take a look at of the MOVE index. So if we're zooming out a little bit, this is the implied volatility, the expected volatility, or the uncertainty in the market regarding the global reserve asset, the US Treasury bond, US government debt. So this is how uncertain the market is regarding the future value of the asset that's effectively at the heart of the global financial system. And seeing this incredible spike higher, it's looking pretty gnarly out there. Of course, you can see in 2020, that was when we saw the real mega spike suddenly, but it's really not looking very good. And when you when you just take a look at how low this has been for so long, if you just zoom back to previous years, you can go through an even longer chart than that if you like. It really is quite alarming to see this taking place. And I thought it would be good to get your input on that, John, as this is, it's an esoteric part of the market, especially something like the MOVE index, because it involves options and it's not immediately, apparent.
I mean, you're right. It's esoteric, but really it is so unbelievably important, because the fact is the marginal liquidity and marginal leverage that exists out there, say for hedge funds and other big players, that marginal liquidity and leverage is sourced in treasury repo. And if the underlying for that repo, that is the treasury itself, is volatile in price, other factors equal, right, it's going to be difficult to maintain your credit lines, right? Banks get frightened when things get volatile like this. So if you're borrowing money and you're putting it in and you're sourcing a lot of that in the repo market, this is a problem for everyone. And so it basically, there's this concept, and it's not just hedge funds. I mean, banks have it themselves, investors have it themselves. There is this concept of value at risk, and volatility is a key component in measuring your value at risk. And whether you're borrowing money or lending money, you have to have a sense of what that value at risk is and what your risk tolerance is. And other factors equal, as things get more volatile, it means you're more likely bumping up against the limit of your credit line, or you're going to face a margin call. And that, of course, means, if it happens, that you have to forcibly liquidate whatever positions you're running. And this is the stuff of financial crises. These are the underlying mechanics in very general, basic terms. So when you see volatility spiking for the assets at the very, very heart of the American financial system, which by extension, of course, is the global monetary base and much of the global financial system, that is a fun chart. And recall that brief spike we saw back in 2020. Remember, the Fed held an emergency meeting and discussed directly lending to hedge funds to help them get out of some bad positions around that time. Something which, of course, is hugely controversial. I mean, the central bank is not supposed to be bailing out hedge funds. Exactly. And yet, of course, they've done it before indirectly. So why not do it directly? I mean, that conversation started back in 2020, and I'm sure it's happening again today.
Yeah, it really sort of pulls back the polite idea of what the central bank's meant to be doing, isn't it? We are rewarding moral hazard.
Well, again, they're not going to say it, but look, that you're absolutely right. I mean, that is what this does, and it's worth a little history here. So, the first time the Fed got properly involved in helping to bail out a hedge fund was long-term capital management in 1998. And if you go back and you read the actual transcripts of the Fed meetings during that time, there was huge dissent within the Fed regarding whether they really should be involved in helping to bail out long-term capital management. Now, they did so indirectly. What they did is they got all the Treasury primary dealers into a room, which was at the Fed offices itself. And they said, look, you guys have to sort this out. As long as you come to an agreement, we'll give you temporary liquidity to implement that agreement. But you're going to all have to agree to take a hit, because there is going to be a net loss here on LTCM's positions because they blew up, right? So you guys have to decide how to divvy that up. We're going to leave that to you. And yes, we will provide you temporary liquidity while you're working through this. Okay. That was the deal that was done. So it was an indirect Fed arranged bailout. If you read the minutes while this was going on, multiple Fed officials used the term moral hazard in those meetings, said, this is moral hazard. We should not be doing this. So the Fed was well aware that what it was doing back then, on a much smaller scale to what you see today, was moral hazard. They saw it for what it was back then. I can't imagine they don't see it for what it is today. They just won't call it that publicly.
No. Yeah, they're just providing the full faith and credit of the Federal Reserve in order to fix financial instability. Yeah, it does. It's funny how once you've done it once, You got to do it again, or you'll end up doing it again at some point. If memory serves, John, it was Bear Stearns that refused to join that coterie of Wall Street banks in the bailout, and it was then that got screwed then in 2008.
I think, look, I mean, I forget all the details here, but as I recall, I think Bear Stearns felt that because they were significantly smaller than the other primary dealers in terms of balance sheet, right?
Yep.
I mean, they actually were quite an active trading house and whatnot, but in terms of their actual balance sheet, it was nothing like most of the others. Um, and so they had so little exposure to LTCM. I think they just sort of felt, we're just dust in the balance here. Why should we have to take anything? We didn't put it this way. If LTCM had only been taking credit from us, they never would have got into a pickle. It's you big banks who are irresponsible. We weren't. We're not systemic. Why should we be involved in taking a hit to stop a systemic crisis? So I think they sort of had that sort of attitude. I'm not saying that's necessarily right or wrong, but I think that's kind of how Bear Stearns looked at it. Whereas I think the way the Fed and the other primary dealers looked at it was, well, you may be small, but you're still a primary dealer. You benefit from participating in this system, and if you're not going to play ball with us, that's just wrong, right? You do benefit from it. I think that's how they would have gone at Bear Stearns. So anyway,
that just makes it even more ironic, though, because Dick Fold's ambition and with going ever heavier into the U.S. housing market is supposedly or allegedly driven by his feeling of inadequacy relative to the larger Wall Street banks. I mean, that's what is I believe the phrase is smoldering envy of the larger banks is what then leads him after this entire debacle to then go so hard and then smash the entire thing on the rocks.
Look, I worked at Lehman for several years, and I worked there at a time when the firm had become very, very proud of what it had achieved, because it really did nearly go to the wall more than once, following being spun out of Shearson Lehman and all that, right? So when it really struggled for a while, and it climbed out of the hole, rebuilt its business, went from strength to strength over a period of many years. And to Dick Fold's credit, I mean, he was in charge during that time, and he surrounded himself with some very, very good people who worked very, very hard. However, you're quite right about the housing market. Lehman saw the growth of mortgage securitization in all kinds of innovative forms, which all blow up in 2008, of course. But you had all this innovation, and Lehman always wanted to be in on it. They saw it as a great way to build their business. They really thought it was the next big thing, and they went just all into it. And again, while the going was good, they did phenomenally well. But then, of course, live by the sword, die by the sword. And when the housing market finally rolled over, arguably it began in 2006. It really got going in 2007. And when the housing market rolled over, then things turned the other way. And all of 2008 was just pure firefighting at Lehman. I had left by that point. I left Lehman in 2007. I felt I kind of saw the writing on the wall. In generalities, if not specifics, but I was concerned. And sure enough, almost exactly 1 year after I left, boom.
That's what happens when John Butler leaves the bank. Well, this has been a fantastic episode, John. One last question for you. This is from a headline here from the FT, which I thought was rather amusing here. German beer drinkers face higher prices at the bottom of the glass. So we've been speaking today about all of the issues that could arise from this massive Japanese yen devaluation, causing lots of stress inside the Eurozone, and then causing lots of inflation and souring asset prices. But I wonder, John, do you think it's going to be the price of a Stein in Germany that finally pushes Germany over the edge and says no to the euro?
Look, it's interesting you say that, because while inflation, in theory, creeps into everything, psychologically, it's the stuff you consume every day that you tend to notice the most.
Quite right.
Not every German's going to go out and buy a car this year, but most Germans are going to be drinking beer regularly. And this is also true of the Czechs, the Poles. I mean, it's true of most Northern Europeans, to be fair. And so this is where inflation will really be visible, right at the bottom of the glass. And and you're going to see you're going to see the margin pass through, right? Let's face it. The cost of brewing beer, because the input costs have gone up so much, the cost of brewing beer obviously is going to have to be pushed through, right? Brewing is a low margin business. It's a very low margin business. So those costs will be pushed through. Absolutely. There's no way that the German population is not going to see inflation, as that headline reads, at the bottom of the glass.
Quite right. You can all think about that, folks, next time you're having a pint, whether or not this could really be what breaks it for the Eurozone. But John, once again, fantastic episode. We covered so much ground here. It's been great to discuss all of these themes.
My pleasure as always, and until next time.
Quite right, folks. Apologies once again for the YouTube stream. We really need to get that fixed. We may end up just streaming on YouTube to avoid this problem, because it's from trying to do multiple different video streams that we found this occurs. But thanks to everybody who has tuned in and asked questions. This has been a fantastic episode indeed. So I wish you all a very good evening, and we'll see you in the next one. Bye-bye.